Hey, future CMAs, so great to have you here today. We're going to dive straight into this explainer on cost of sales analysis. I know how challenging this syllabus can be, but I promise you, by the time we finish up today, you're going to feel incredibly confident about analyzing profitability, breaking down those tricky variances, and dodging the traps the ICMA loves to set.
To keep us on track, here's our game plan. We'll look at the big picture of COGS, what actually drives gross profit, those accounting choices that distort things, how to solve a variance problem, and finally, 3 golden rules for your exam.
All right, part 1, the big picture of COGS.
Think of revenue as the shiny exterior of a car, right? Well, cost of sales, or COGS, is the heavy machinery under the hood doing all the real work. To analyze it properly, we always pair it with gross profit analysis. The math here is your absolute bedrock. Gross profit is simply net sales revenue minus cost of sales. And your gross profit margin percentage, that's just gross profit divided by net sales revenue. Seriously, burn this equation into your brain because literally everything else we're going to talk about builds on this.
So why do we care so much about this one specific expense? Well, for a lot of manufacturing and retail companies, cost of goods sold eats up a massive chunk. We're talking 40% to 80% of every single sales dollar. It is usually the biggest expense on the income statement. That means even microscopic shifts can make or break a company's true profitability. Honestly, just a 1 or 2% creep in COGS can completely wipe out net income.
Moving on to Part 2, Drivers of Gross Profit.
The ICMA really wants to know if you understand what pulls the operational levers behind the scenes. When a margin shifts, you've got to look at 3 main culprits. First up, input cost changes. Did the price of raw materials or labor rates jump? If they did and you couldn't pass those hikes on to the customer, your margin shrinks. Second is manufacturing efficiency. Was there a bunch of scrap, rework, or just general waste on the factory floor? That kind of operational mess inflates costs without adding a single cent to revenue. And third, production volume and overhead absorption. In manufacturing, fixed overhead gets baked into product costs. If production volume drops, that overhead is suddenly spread over fewer units, which drives up the unit cost of sales. So if gross margins are bouncing around, these are the 3 places you go looking for answers.
Okay, Part 3, Accounting Choices that Distort. Now, sometimes the numbers jump around not because of anything happening on the factory floor, but purely because of accounting rules. Especially in an inflationary environment, how you match older versus newer inventory costs against current sales completely rewrites your reported profit. Take FIFO. You're matching older, cheaper inventory against current sales. This gives you a lower cost of sales, higher profit, and higher taxes. But with LIFO, you're matching the recent, more expensive inventory against current sales. This means a higher cost of sales and lower profit, but it beautifully creates a tax shield that keeps cash in the business.
But listen closely because this is a massive trap the examiners love to set. Beware the LIFO liquidation. If a company dips into its older, super cheap historical inventory layers and sells them off, it artificially plummets their COGS and makes gross profit absolutely surge. So, rule of thumb for the exam? Always flag LIFO liquidations as non-sustainable profit. It's an accounting illusion, guys, not some sudden stroke of business genius.
Our next big accounting choice is absorption versus variable costing. Under GAAP, absorption costing assigns all overhead, both variable and fixed, right to the units produced. Variable costing, which we use internally, treats fixed overhead entirely as a period expense. Why does this matter for the test? Well, if production outpaces sales, fixed overhead actually gets trapped in inventory under absorption costing. This artificially lowers your cost of sales compared to variable costing. Basically, it makes profitability look way better in the short term just because the company overproduced.
All right, on to part 4, solving a variance problem.
You guys are doing great, so let's take a breath and actually work through a classic CMA-style scenario together. This is where you really separate the passing scores from the pack. We've got the financials for Matrix Corp right here. In year 1, they pulled in $1 million in revenue with a 40% gross profit margin. Year 2, revenue climbs to $1.2 million, but look at that. The gross margin dropped to 35%. Now, behind the scenes, we know year 2 unit sales went up by 20%, with flat selling prices, but raw material prices rose by 10%. As analysts, our job is to pinpoint exactly why that margin dropped.
Let's break this down into 3 simple steps. Step 1, calculate the expected COGS based entirely on volume. Since volume grew 20% and prices were flat, our expected COGS is year 1 $600,000 times 1.20, giving us $720,000. Step 2, we identify the cost variance between what actually happened and what we expected.
In step 3, we dig in and evaluate the strategic root cause of that variance.
So for step 2, actual COGS in year 2 was $780,000, not the $720,000 we expected. That reveals a huge $60,000 unfavorable cost variance. And for step 3, what's the root cause? Well, that entire variance was driven by unabsorbed material price inflation. Basically, that 10% hike in raw material costs that Matrix just couldn't pass on to their buyers.
Now, I want you to pay close attention to how we word this. If you get an essay question, using this exact phrasing is going to show the graders you truly know your stuff. It goes like this. Matrix increased revenue by expanding volume, but its gross profit margin compressed by 5 percentage points because cost of sales grew faster than sales due to unabsorbed material price inflation. Seriously, practice saying that. It's exactly how a certified professional explains margin contraction.
Finally, part 5, 3 golden exam rules. Before we finish up today, I want to hand you a protective shield against the most common exam traps. I see students fall for these all the time, so please jot these down. Rule 1, always watch inventory turnover right alongside COGS. A rising cost of sales paired with slowing inventory turnover is a massive red flag for obsolescence or future write-downs. Rule 2, never ever put operating expenses like SG&A into cost of sales. They are period expenses, not product costs. And Rule 3, always isolate production volume variances caused by idle capacity. If production drops below normal capacity, GAAP demands an immediate charge to cost of sales. Getting these supply chain dynamics down and strictly separating period from product costs is literally going to save you points on exam day.
At the end of the day, analyzing COGS isn't just doing math. It's about really understanding a company's pricing power and operational reality. Keep working hard, trust your preparation, and I'll leave you with this one thought to chew on before our next session. If a company's reported profit is absolutely surging, but their inventory turnover is completely crashing, are they actually profitable, or are they just hiding costs in the warehouse? Think about it. Good luck studying, and I'll see you next time.